Hi, good evening, everyone. Welcome back to the channel. So, a probing question that I want to focus on this video: why is the market dropping if we're so bullish on 2026, if we're so bullish on AI, if we're so bullish on tech and the market in general? So, I'm going to go over the top reasons I'm still bullish on the market in 2026, despite recent drops the last couple weeks. So, the market has been very frustrating the last few weeks. Quick AI overview for reasons for a bullish market outlook for 2026 include strong corporate earnings, the ongoing AI investment boom, potential monetary easing by the Fed, and supportive fiscal policies. So everything aligns to a market boom in 2026, in my opinion. The Fed has actually already started quantitative easing. Last Friday, after the Fed cut interest rates on the 12th, they actually announced more bond buying and more liquidity being injected into the overall economy, which is the definition of quantitative easing, specifically starting with the bond buying and stuff, which we'll cover. Um, Now, what's hurting it is that Papa Powell told us that we are only expecting like one rate cut in 2026. So now the market is freaking out, pricing that in. But anyway, let's go over key factors contributing to a bullish 2026. So robust earnings growth. Wall Street anticipates resilient and accelerating corporate earnings, with some forecasts projecting an 11.8% increase in aggregate S&P 500 net income for 2026. So at some point, with all these positives, it has to affect the market. It's like basic physics. If the net incomes of all the companies in the S&P 500 are expected to be up almost 12%, like by default, the S&P almost has to be up, right? So at some point, we have to start seeing things go up. Like I've been saying, it feels like there's no juice to the market, but there is now. Now that quantitative easing is slowly but officially starting. Welcome, Nick Silver. And thanks everybody for tuning in live. Comment in the comment section, by the way, why you all think the market's dropping. And to me, I think it's like I'll call it a gaslighted reality. It's a false reality. The market, we should not be dropping. We should be doing very well. So this earning strength, rather than just a valuation expansion, is expected to drive market returns. And then the AI revolution and productivity gains. The massive AI investment cycle is a primary driver of growth, with analysts viewing the boom as being in its middle innings rather than an immediate bubble. That's a good analogy. Increased AI adoption is expected to lead to company-wide productivity improvements and efficiency gains across various sectors. And everything I keep seeing, literally every company I'm researching for AI, they're expanding data centers, they're building out new infrastructure, they're expanding their inventories, they're increasing sales, they're increasing, their growth across all dimensions. So at some point, like the rubber has to meet the road. All of these things that are happening have to lead to these companies going up, I would expect. And then for monetary policy shift, while current official Fed forecasts project only one rate cut in 2026, there is speculation that a potentially more dovish Fed chair nominee could lead to more aggressive interest rate cuts. I think 100% that will happen. Now, remember, it's a vote of the board. It's not just the Fed chair cutting rates unilaterally. Lower interest rates generally boost asset valuations by increasing the present value of future cash flows, which directly impacts the balance sheet of companies. And then supportive fiscal policy. The One Big Beautiful Act, which was passed in the summer, permanently reinstates 100% bonus depreciation for qualified property, is expected to encourage significant capital expenditures beyond AI, stimulating investment and economic growth. So it extended all of the tax cuts from the 2017 Tax Cuts and Jobs Act. In addition, no tax on tips and so on and so forth. There's many things that should stimulate not only Wall Street, but blue-collar America as well. So it's a win-win all around. Resilient economic growth. The Fed has slightly upgraded its real GDP growth projections to 2.3%, suggesting a stable economic environment that supports a bull market. I actually went and looked at GDP numbers today, which I haven't looked at in a while. I didn't realize we grew at 6% in 2021, but I've been looking to see like what gives. Why is this market so, anemic is the best term I can describe. It's been a maddeningly frustrating market because it's been just dropping, like there's no juice to it. But at some point here very soon, I think we gotta be turning around. And then widening market participation. Now, this is another thing I want to talk about. I saw recently that there's like 7.5 trillion or something in CDs and money markets because interest rates were higher, which drove tons of capital towards safe assets. Now that interest rates are falling, that money is going to pour out of CDs and money markets and back into the stock market, which is going to fuel more growth. So while a few mega cap tech stocks have driven recent performance, some analysts foresee the positive tailwinds, such as accelerating economic growth, supporting a broader range of stocks, including mid and small caps in sectors like healthcare, energy, and software. So more sectors should be participating in it. These factors have led to major financial institutions such as Oppenheimer, Deutsche Bank, UBS, and Goldman Sachs to set optimistic year-end 2026 targets for the S&P 500. Okay, now let's do this. GDP. I want to talk about GDP. We'll just say over the last 20 years, because this is important. The economy doesn't grow at the rate that it used to. So everyone that talks about, oh, we're going to get back to the good old days of like 5% growth and whatnot. Oh, nice. Yeah, you got the haircut like me, huh? You like my haircut? Okay, so from 2005 to 2015, actually our best year was 2021. So don't we miss Biden now? I'm just joking. That was natural though, because what it was a rebound from COVID, right? So if we look back to, hold on a second, I don't want this. GDP by year over past 20 years. I want to make a point here. So this is more of like a macroeconomic video, which I know is not going to do well, but it is what it is. I like to talk about these topics too. Okay, so we've been growing pretty much below 3% for the last 4 years. We grew at 6.2%, but this was the comeback from COVID. We were only down 2.1% in 2020. So we had a very mild recession. And then in the first Trump term, we had 2.5% growth, 3%, 2.6. Then we contracted. We were on pace for a very solid 2020 until COVID hit. And then, of course, 6.2% in 2021. Before then, the emergence from the Great Recession of 2008, we had, we were barely up in 2008. Of course, it hit, really Q4 of that year, then negative 2.6%. Then we grew at 2.7%, 1.6, 2.3. So we've been in the twos. We've been in the mid to high twos for a long time. So the economy doesn't grow like it did in the 80s when it was like, or even in the 90s when it was 4 and 5% per year. Basically, I think AI will help stimulate GDP, but for GDP to be above 4 or 5%, you have to have like a major invention. So like obviously in the late 90s, it was the dot-com boom. So you had all the internet stocks, all the technology stocks and things like that. We could see similar, with AI, but it's got to be a major. And we studied this in one of my classes in my undergrad finance program, how basically for GDP to grow significantly, a major invention has to improve the economy so much that it's like a shock to capital, labor input, so much so that GDP grows at a rapid rate. So this is all important, the numbers on the ground, so to speak. Now, the biggest thing, the latest, shall we say, crisis du jour that the media is freaking out about is unemployment. And I know most of us have a short-term memory. So the media is crying chicken little over the unemployment rate. So let's do this here. So unemployment rate is the newest thing that they want us to freak out about. They're saying, wow, unemployment rate is the highest it's been in 4 years. Well, me remembering the 2008 Great Recession, I remember unemployment rates at 10% or higher. I actually remember Q2 and Q3 of 2020. Wasn't all that long ago. I remember when the unemployment rate hit 15% for one quarter. Those were Great Depression level numbers. So by comparison, there's such a thing when you study economics, there is such a thing as what's considered full employment. So our economy structurally can never be at a 0% employment rate. There's always going to be people that don't work, that are either, retired, out of the labor force, disabled, old, young, so on and so forth. There's going to be a natural rate of unemployment. 4.6% is an uptick, but it is, historically speaking, a very solid low number, which signals a very healthy economy. Now, the economic context that the AI is giving us here, it's saying it's a 4-year high for unemployment and that the labor market is cooling. They keep talking about that. It's annoying. It's almost like the media wants to will bad stuff into being, which is so annoying. I wish the media operated at a more positive frequency, but it just doesn't. So by comparison, in 2024, we were at 4.1%. 2023 and 2022, we were at 3.6%. So these numbers here, folks, these are very, very solid numbers. Any number below 4% is like historic lows. Now, the lowest we've been was actually, if you look historically over the last like 60, 70, 80 years, at the end of World War II, when the economy was at full production, we had like a 2% unemployment rate, even into the 50s, because there was so much production going on. You had, like Rosie the Riveter, you had women working, men working, everybody was working. So you had very low unemployment rates. So by comparison, in 09 and 10, we were almost at 10%. 2015, we were at 5.3%. What's interesting, it took so long to recover from the Great Recession. It took the economy was probably at a high unemployment rate for another 6 or 7 years. This affected me when I was coming out of college, the aftershocks of it. But by 2019, we had hit below 4%, and then we spiked in 2020. This is what I was talking about here. We peaked at 14.8% due to COVID-19. And then before then, we had the best economy ever in the last 50 years, basically pre-pandemic 50-year low. And we were just about back to that, actually. So this surpassed a 50-year low in 2023. So they considered 2022 a full post-pandemic recovery. And then the market followed soon after. Now, there's another headwind we have to think about here. If you all are liking what I'm laying out, by the way, please smash that like button, 2 thumbs way up. It greatly helps the algorithm, greatly helps me to produce more videos like this. If you like this keen commentary and the keen insights on such subjects, smash the like button. Thank you. Okay, so next thing we're going to look at, how often is we'll just say the S&P 500 up over 3 years in a row. Now, this is a headwind because basically the S&P has been up 3 years in a row, 23, 24, and 25. We had a down year in 2022. Before then, 2021, 2020, 2019, 3 years in a row. Then we had a down year in 18. So it's happened basically, it's finished with a positive return for the 3 consecutive years, 12 times since 1928. And it's on track to do so for the 12th time at the end of this year, unless we have a massive collapse in the last, 2 weeks or so. This makes 3 consecutive positive years in a relatively uncommon event, occurring roughly 12 out of 98 years, which is 12% of the time. Okay, so it happened in the 40s, and then it didn't happen again until the 90s, the dot-com boom, which I was just talking about. By the way, these 5 years, folks, were 3 of the best years the S&P has ever had. And then the post-Great Recession bull market, 2012 to 2014. I remember the year 2013 was on fire. And then basically 2015, we were flat. We could have actually surpassed this because 2015 was the one flat year in like a 7-year span. It was 2012, 13, 14, 15, 16, 17, a 6-year span, sorry. 2015, if it had not been for Congress arguing over budgets and stuff like that and debt reduction, we could have had a positive year in 2015. And then from 2019 to 21, we had a 3-year. So the moral of the story, and we're at a 65% cumulative rate of return. The moral of the story is the negative Nellies out there want to say that, oh, we're at the 3-year mark here, so that means we have to drop, because people just want to believe that, oh, we have to follow historical norms. Who knows? We could entirely set a new pattern, which I fully expect us to do, by the way, because the full palette is there for the artists to paint, basically, us being the artists. The full palette, we've got tax cuts, we've got no tax on tips, we've got stuff to help blue-collar America, Wall Street. The corporate tax cuts were extended, like we said, depreciation, all those things. Those tax rates, they all go into effect January 1st, 2026. We have the Fed cutting interest rates. We have quantitative easing. That's the next thing I want to talk about. Now, these things aren't guaranteed, okay? So this is important. Quantitative easing, watch this, has QE started? And the answer is yes. It started Friday and Powell, if you listen to his speech, he announced it when they cut rates. So the Fed has officially ended its quantitative tightening and started purchasing short-term Treasury securities in December. While the Fed avoids calling these actions quantitative easing, many analysts consider the effect expanding the Fed's balance sheet and injecting liquidity to be a de facto restart of QE. So the overview, QT ended December 1st. When they announced the interest rate cut, they also announced asset purchases. They're now undertaking what they call reserve management purchases. That's the new buzzword for it, or RMPs, up to $40 billion in Treasury bills per month to ensure an ample level of bank reserves in the financial system. This, folks, is going to help the markets. This is going to help inject liquidity into the system. Cutting interest rates. In a separate but related move, the Fed lowered the benchmark rate by 25 basis points. of to make it a target rate of 3.5 to 3.75%. So not officially QE, but it's a QE. It basically is QE. Now here's the thing: is QE guaranteed to boost the market? And the answer is going to be no. By the way, for those of you that have followed me for a long time, you know about my 8-ball. Google AI has officially become Coach's new 8-ball. So here's the answer. No, quantitative easing is not guaranteed to boost the market, though evidence suggests a strong positive correlation. And we'll show that chart as well. QE's effectiveness is influenced by numerous factors, and its impact is not guaranteed. Now, here's the thing. Whether or not it works, it tends to be whether it was a cause or effect. It tends to be rooted in the reasons why it was done. Was it a cause or an effect of something? Basically, there's no recession. It's not being done to mitigate a recession. So the way I said, when it's not done for those reasons, it tends to boost the markets. Here's the thing, the nuance that you all have to understand. In the long term, it always boosts the markets. You could look at 2009 when it started. You know, we had negative GDP, but the market still eventually went up. About a Japan rate increase, I don't know. I don't really follow Japanese monetary policy. But anyway, all right, let's see. Correlation between market going up and QE. Let's do this. And I'd like for it to bring up a chart. So strong positive correlation. It's pretty much going to give me the same thing. Lower interest rates, portfolio rebalancing. See, lower returns on bonds and cash. Investors reallocate their capital into riskier assets such as equities to find stronger returns. The added liquidity allows banks to lend more cheaply, encouraging businesses to borrow for expansion and investment, which improves fundamental outlooks and further increases stock demand. By purchasing government and corporate bonds, central banks drive up their prices and push down their yields, which serve as benchmarks for other lending rates. This makes saving and safe investments less attractive. Correlation versus causation. Remember, like I like to say, correlation does not prove causation, although it's a strong indicator. The high correlation does not mean QE is the sole driver of stock prices. Other factors like corporate earnings, government policy, and overall economic health also play significant roles. But I just outlined above, how it can cause directly, it can directly cause stocks to increase because the added liquidity, it allows banks to lend, which encourages businesses to borrow for expansion and investment, which improves fundamental outlooks and further increases in stock demand. Mixed international results. Studies have found the effect of QE on stock markets to be significant in the US, but with limited to no effect found on indices in the UK and Japan. So for international investors, not so great for you, but I'm very pro-America, so I like what we have to offer here. Now, you can look at charts and things like that, and basically QE and markets going up are pretty much identically correlated. So on that note, folks, I am still strongly bullish in 2026. We need the markets to go up, honestly. So let's see what Eugene says here. Welcome back, Eugene. Long time no see. January to March, I think will be very choppy. I agree. If not a total drawdown of 15%. God, I hope not. Me personally, I'm kind of a little selfishly motivated. I need stuff to go up. Hopefully, you know, and I know a lot of us are in the same boat, but a lot of us need the market to increase in the first quarter because we need to be able to survive. The key is to weather the storm, right? The key is to be able to stay in the game. As long as you can stay in the game, you can do very well, but you got to be able to stay in the game. So yeah, QE is super important for risk on assets. If not a total drawdown of 15%, won't start improving until around the new Fed chair. God, that's a long wait. I wish Powell would just leave, but you know, he's going to hang around as long as he can until May. He says, tell me about it. I don't want to draw down, but I'm preparing for it. Huge cash pile. I honestly, to be honest, I wish I stopped trading in October. Like around Halloween, that's when everything kind of went to shit. If I had stopped trading, I was up almost 500,000 for the year. And I'm going to be holding the bag on a lot of stuff, and I'll probably be out of a job too. So it's not going to be fun, but that means full-time YouTubing, right? At least I get my couple $100 in ad revenue. That'll help me pay my house, right? Yeah, exactly. I wish I just stopped trading in October. I had no idea, and I don't understand. That's why I'm doing this video, because I honestly, as much as I've studied this, I don't understand why the market is dropping. It's one of the most frustrating markets I've ever been involved in. We share the same pain. Always want to be a part of the shit with other. I agree. I'll probably have to be an Uber driver on the side or something. But anyway, hey folks, thanks. On that note, I tried to will some positive energy into the stock market here, so hopefully it works. Thank you all for tuning in. Like, comment, and subscribe, and join Discord, and we'll see you all in the next one. Take care. Bye.